Welcome to Theo Trade. I'm Jeff White, and what do you know? We have reached the end of 2015. Congratulations, you've survived. The finish line's in sight. And the big question is the S&P going to finish above or below the flat line for the year? The 2014 close was at 2058.9. We've been kind of zigzagging in recent weeks, and we're still within reach of it, but it's going to have to hurry and kind of get up on its horse if it wants to get back over the hump. So, we'll find out soon enough. But as you sit down at your trading station or you sign into your favorite mobile trading app, I know what mine is, you should understand, just like every professional trader does this time of year, that there are some very unique and distinct cross currents at play here at the end of the year. And that's what I want to discuss with you for a few minutes in this video. You may have heard of them or completely overlooked them. But either way, these absolutely will affect the way in which stocks and the broad market will move in the days ahead. Now, these cross currents include but are not limited to things like tax-related selling, index rebalancing, quarter-end and year-end window dressing, fund redemptions. We're going to see some days of lighter holiday-related volume and other things like that. But that right there is a pretty fair list. So let's briefly discuss each one of them, and let's look at how they might motivate the actions of institutional traders who are the true market movers, because they're dealing with the big money. And let's start off here with this idea of tax-related selling, because obviously taxes are done on a calendar year basis, and we come to the end of the year. It's no surprise that institutions and individuals alike are naturally going to want to either book gains in particular securities or losses for the tax purpose of the end of the calendar year. So just for the fun of an example, let's say this hypothetical fund that we're discussing, maybe they own a real dog like Chesapeake Energy, CHK. Yikes. I mean, this thing has been annihilated this year along with many other names in the energy sector. And you could say that this thing has fallen out of the ugly tree and hit every limb on the way down. But let's say that simultaneously, this same fund owns Amazon, which has had a substantial run throughout the course of the year. And we can see even here lots of gaps to the upside that coincide with earnings reports. No big surprise. But each time to the upside over the course of this year, big jumps higher, trending between earnings reports a little bit to the upside, mostly lateral. And so we're kind of seeing a big advance and then some digestion, then another advance and some digestion. So that's kind of been a really nice stair-step type of move for Amazon. It's been an amazing run, you could say, pardon the pun. But maybe this fund sees the opportunity to close both of those positions out to somewhat offset each other. And so they don't mind cleaning up their book a little bit, so they close them both out. And that's obviously just a very simple scenario, and there'll be many different ones along those lines, but that's going to affect how the market moves. There's also the very exciting topic of index rebalancing. So back to something like the SPX. We're going to see a lot of the indices officially replace some of their current components in lieu of more fitting ones. The fact is that as time goes by, some stocks eventually no longer warrant inclusion in a particular index, so it's going to be removed. That means that all those index tracking funds out there have to make the shift out of that particular security, as well as add some exposure to its replacement. So you're likely going to notice a handful of names getting abruptly dumped, while a few others suddenly gain favor, and that's why. But what about quarter end and year end window dressing? Doesn't that play a role too? Well, absolutely it does. And as portfolio managers come to grips with their performance anxiety and they recognize the presence of some market laggards that they may be holding, something perhaps like KMI, oh my goodness, among their holdings, let's say among their top 10 holdings list, they may not want to advertise that to their fund shareholders, so they may aim to exit those positions. That way, their reports to shareholders and perhaps their prospectus can be free of those unsightly tickers, and maybe they want to replace it with something, let's say, a little bit more attractive. Maybe something like Nvidia that's been running higher over the past several months, because that's going to be a little bit more brag-worthy. I mean, after all, your confidence in that fund might suffer a little bit if you see that they're holding some dogs that are in the midst of a year-long death march into oblivion. And that leads us to another topic, which is fund redemptions. The new year is an obvious time for a fresh start in lots of ways. I mean, whether it's your diet or exercise plan, or the places that you invest your money, it's no surprise that this time of year there are lots of fund investors who decide that they want out. So maybe they found a better opportunity, so their fund shares get redeemed and the cash equivalent is returned to the investor, and it takes the selling of some securities in most cases to free up that cash, which of course can impact how stocks move. And that happens throughout the year, but it definitely happens at the end of the year. And then of course there are just the lighter days of volume that we often see around holiday weeks. Typically the lightest two volume weeks of the year are the July 4th week and Thanksgiving week, and those are abbreviated trading weeks with market closures as well, but the activity is naturally lighter with the attention of market participants understandably directed elsewhere. So the final week of the year is no different when we have two holidays, Christmas and New Year's, during which time traders are traveling or they're entertaining or whatever it may be. I mean, it tends to produce some lighter activity days, and that's just natural, but that can definitely mean slightly less liquidity out there. So the bottom line here is that there are lots of unusual factors at play right now that aren't there during the other 50 or 51 weeks of the year, which very well may influence the price action in some odd and unusual ways. Maybe you like the sound of odd and unusual, I don't know. But I will say this, expect it between now and the completion of the year. And along with that expectation, it only makes sense to trade a little bit more cautiously, a little bit smaller as a result. I mean, look, I'm a positive thinker. I love to trade. I like to set lofty goals and then work really hard to reach them. And I hope that if you're trading these last few days of the year, that they are the cherry on top of a very nice year for you. But the fact is that if you haven't had a nice year already, that's not likely to change over the course of the next few sessions. So don't embrace this go big or go home mentality for the next few days. Realistically, these last few days may be a little bit choppy and confusing because of all these cross currents. So focus not on what you need to see happen in these final few days of the trading year, but rather on what you'll aim for once January 4th arrives and the trading begins for 2016 and the market reopens, okay? That way you can cruise into the new year with your objectivity intact, which is so critical. I mean, that always makes for better trading. Just don't let these December, this whirlwind of cross currents throw you off balance. Thanks for tuning into Theo Trade.